So, guys, I want to go over recasted EBITDA. Most people get the EBITDA confused and they don't know how to properly calculate it, which may mess up. Well, not may, it can mess up the value of what you're valuing your company. So, I want to go over recasted EBITDA and things you need to add back or take back depending on your situation. So, if you're looking at this screen here, we start with net income, and this is going to explain what EBITDA is too as well. You start with the bottom line of your net income. You add back your interest. That's the finance charges. Say if you got a building that you took out a loan for, those are the interest payments towards that. You add back your taxes. You add back depreciation and or amortization if you have that. That gives you your EBITDA, the earnings before interest, taxes, depreciation, and amortization. EBITDA. That's everyone knows about that part. But there's some things you need to reclass so the person that's buying your company knows exactly what they're buying. And those are like one-time add backs, one-time transactions, maybe M&A or legal attorney fees that you may occur one time, but you won't occur again, right? It could be like you had a major cleanup and you had to pay your accountant $40,000. I don't expect you to have a major cleanup each year. Therefore, that was a one-time expense that your accountant's going to charge you for. But I'm actually going to add that expense back to the profitability because I don't expect that to be a recurring thing. So let's go over add backs. Owner's personal expenses, auto travel meals. I have clients that sometimes it's a lifestyle business. They travel a little bit more often than needed than what's for the business. We're adding that back. Excess owner compensations for those owners that's paying back above that reasonable comp rate, or just a reasonable owner salary compared to what the market is. We're adding that back. Also for the family members, if they're being paid, we're adding that back. Say if you hire your children and your children, maybe the job isn't really needed, but you did that for a tax strategy, a play or move there. We're going to add that back. One-time legal expenses, M&A consulting fees that you don't normally have, we're adding that back. I had a client that during the first phase of their company, they spent a lot on education. Well, he doesn't need that anymore. He's already educated. Therefore, those expenses that he's incurring for consulting fees that he has on the books, we're adding those back. One-time repairs, any one-time expenses, guys, that doesn't normally happen on a monthly basis or weekly basis for your company. Any startup or expansion costs, things that just, it won't be, and I don't want to overcomplicate this. It's basically expenses that won't be needed anymore if the business owner takes it up. If you have a luxury Houston, Texas suite that you use to probably market, maybe you don't truly need that in order to run your consulting company. Therefore, I'm taking that and I'm adding it back to the profitability. It's going to make that recasted EBITDA a little bit stronger. Take backs. So basically, these are things that I'm taking away. Sometimes owners, not sometimes, let me stop saying that part. Owners, when they know that they're about to get into sale, they minimize their expenses in order to strengthen that EBITDA. Well, any good buyer are going to open up the hood underneath that and look into that and just eat that up. They're going to question that. So in order just to basically just do good faith and kind of get past that step, we add these take backs to get the true value. Like if you paid yourself, let's say $20,000, but you know your fair market rate of your salary, your reasonable comp of your salary is around 50. That 40,000 difference, or whatever else, I think I said 10,000. That 40,000 difference is basically I'm going to subtract that from your EBITDA, just because you know you're paying yourself below rate, just because you want to strengthen up that EBITDA. Any good buyer that's going to look at your company, they're looking at that information. So here's a simple example. You got your EBITDA, your net income plus interest, taxes, depreciation, amortization. You add in your add backs, you subtract your take backs, and that gets you your recasted EBITDA. That's what we're going to market with to apply against the multiples to get your true business value to see, hey, this is the company's worth. This is how much the market price is what I'm putting onto the market to sell. You want that recasted EBITDA, not the normal EBITDA. Big difference. Hope I provided value. If you have any questions, please reach out through a discovery call. My name is Christian Onyemem, specializing in companies that's buying or selling. Thank you.